Hey, what's up, Dividend investors? Mike Hiru for Dividend Stocks Rock here. I hope you're doing well. In this time of uncertainty, one thing that is crucial is investing in healthy companies with a robust balance sheet and a strong business model. One indicator that can tell you that a business is doing well is to follow their dividend increases. Because of course, when you think about that, if management is willing to increase its dividend by more than 10% on a year, well, it tells you that they have a lot of confidence in generating more cash flow in the future. And as an investor, that's a pretty good sign. So today we're going to review 10 Canadian stocks that offered a 10% or more dividend increase in the last 12 months. I could have came here with classic names such as Dollarama, EQ Bank, Stella Jones, Brookfield Asset Management, TFI International, or Weston, and many others. But I decided to dig a little bit deeper, find some under the radar companies. And for each of them, I'm going to give you the bear case and the bull case. So let's get started with Bird Construction, ticker BDT, a construction business not to confuse with companies like WSP Global or Stantec that are engineering firms. This one is really focused on building stuff. So infrastructure, buildings, industrials, and the latest increase was from 4.7 cents up to 7 cents, so a 49% dividend increase. Kind of crazy. So the bull case for Bird Construction, well, first they have a diverse portfolio. They have many clients across Canada, and they also focus on different types of industries, including healthcare, education, industrial facilities. So they are well diversified. The second point is they also grow by acquisition. As of late, they have made the acquisition of Jacob Bros Construction for $135 million. There are a lot of potential in this fragmented markets, opening the doors to more growth by acquisition going forward. The last but not the least, the company shows a very strong dividend triangle, especially for the past 3 years, where you can see revenue, earnings, and dividend going up so fast. So unfortunately, there is also a pretty solid bear case. While the past 5 years shows a very interesting dividend triangle, keep in mind that Bird Construction is a highly cyclical business. During downturn, it's not going to look that great. As an example, if you look at the dividend triangle, but between 2015 and 2020, you see declining revenues, declining earnings, and a dividend cut at the beginning of 2017. So keep that in mind if you're about to invest. The second risk is there is also a project execution risk. The company counts a lot on large capital investment projects, such as like major project in infrastructure or industrial development. But the thing with those is the more they invest in those, the more they could fail delivering the project, so that the margin could quickly turn down. Finally, it is a small capitalization. You're going to hear that a lot in today's video. When you invest in a small cap, it means that it is highly volatile, and as you can see in the past 10 years, the business can also be crushed rapidly. Moving on to another small cap, Supremex, ticker SXP.TO, specializing into envelope and packaging, a little bit with labels, but it's mostly envelope at 70% of the revenue. The latest increase of the dividend went from 4 cents to 5 cents for a 25% increase. So on the bull case, well, the company is a market leader in Canada for the envelope, so they are dominating this market, which is great. They also have the ability to grow by acquisition. There is a fragmented market here, so it's also opening the doors. As of late, they have been expanding their business in the US and expanding beyond envelopes, getting into packaging and specialty product to get a little bit more diversification. On the bear case, well, this one is a ultra small capitalization. We're talking about less than 100 million of market capitalization. It comes with crazy volatility. Just be aware of that. The other thing is, well, who buys envelope now, right? So there is a declining demand for envelope. They absolutely need to expand into new market segment if they want to survive and thrive. And I was actually surprised to see that the business was showing better numbers as of late. Finally, Their expansion will go through acquisition, so there's an integration risk whenever they will make an acquisition. Third on my list, we go now into the financial technology sector. So a fintech, Propel Holdings, PRL.TO. This is a fintech using AI for its lending platform, operating in the US, Canada, and United Kingdom. They focus on small unsecured loans, and they focus on underserved consumers. What that means? Well, it means like people that are having a hard time getting credit from a classic bank. Latest dividend increase went from 15 cents to 16.5 cents for a 10% increase. So the bull case, well, first things first, the company shows a robust dividend triangle, which is explained because the business model is highly scalable. They have their lending platform, they're boosting their underwriting process with AI, so it's really easy to just expand and give more credit to more consumers. The second thing is, of course, their proprietary lending platform. They own a pretty unique way to underwrite their loans, and so far they have been able to lend the right amount to the right person at the right interest rate to make it highly profitable. Finally, it is a niche market where most banks are not interested into consumers that have like bad credits or no credit at all, or have like a business and they're not able to declare earnings, declare solid revenues. So it's a great way for them to grow where most players in the bank industry are not really interested. On the bear side, well, it is another small cap. So we're talking about 1 billion. So you probably saw the stock price went from 42 bucks to 25 in a few months not too long ago. Be ready for a roller coaster. The second thing is, well, when your niche is giving loans to people with bad credits, well, there's a reason why those consumers are underserved, right? It is because it has a higher level of risk. Finally, I would say that this type of business looks good on prom night. When the economy is thriving, this is the type of platform that will make a killing. But on the other way around, while now we are waiting for a recession to happen, maybe it's not the right time to look at Propel. So I'm going to leave that into your hands to make your due diligence. So enough for the small guys for a while. We're going to take a pause and move on to some big corporation. Number 4 on the list, Cameco. So Cameco, CCO.TO, our uranium producer. The latest dividend increase was from 12 cents to 16 cents for 33% pay raise increase. On the bull case, well, increasing demand. There are right now 62 new reactors under construction across the world, including 28 in China and 10 in Asia. Cameco is a major player, and it is a lot more stable from a geopolitical point of view than other of its competitors because it's based in Canada. And finally, since uranium trend is going up, well, the price will likely go up, improve Cameco's margin in the future. On the bear case, well, as I just said, if uranium goes up, Cameco is going to be a winner. If it's the opposite, well, it's also going to be a tough ride for them. So commodity price, volatility, just always part of that deal when you invest in a material related company or in an energy related company. Regulatory risk and public perception challenges. We're talking about nuclear. A lot of people are saying that it's safer and it's greener. When there's a problem with the nuclear reactor, we're not that happy about it. So you have to consider this before investing. And the third point for the bear case is operational risks as the company mines uranium. This is also part of their business flaws. Moving to number 5, a very well-known company, Imperial Oil, IMO, a vertically integrated oil and gas business. The latest dividend from 60 cents to 72 for a 20% pay raise. The bull case starts obviously with the vertical integration, enabling profit margin increase at every step of the process. The second thing is it leads to being a free cash flow making machine. As you can see on this graph, the company is breaking even with an oil barrel at 25 bucks and can cover capex and dividend payment at an oil barrel of 35 bucks. We're pretty far away from current level, so it means that Imperial Oil is generating a ton of cash flow. The third one is, since they have high quality asset, they have also the ability to ramp up production whenever the oil barrel goes higher up. On the bear case, well, of course, energy rhymes with cyclicality. Cyclical business, if the oil price goes down, Imperial Oil stock price will also follow. We have also environmental and regulatory challenges on this one. Developing new projects will always be a little bit difficult with more environmental concern. The third one is operational risk as well, because they have some aging facilities. So they are stuck between reinvesting in those facilities to make sure there's no spill and no environmental disasters. And at the same time, if they do that, they also hurt their profits. So sometimes we have seen companies in the past too kind of forget to do all the maintenance that it should be doing. We're moving now into the technology sector with Enghouse, ENGH.TO. This company specializes into contact centers, video software, and services. The latest increase went from 26 cents to 30 cents, so a 15% pay raise. The bull case on this one, well, it's a SaaS business, so software as a service. That equals recurring revenue. We love recurring revenue because it's a constant flow of income. Organic growth plus acquisition. The company is able to grow their client base with their existing offering, but they also eye on acquiring new technologies from competitors. So it's a great way to increase their business going forward. Finally, the company has no debt and lots of cash, so it enables them more flexibility to make those acquisitions and also reward shareholders with dividend increases. On the bear case, well, if you look at the stock graph, you're going to notice that there was a huge COVID hype, of course, with a lot of people working from home. That hype is over, so the stock price decline. It is a small capitalization, showing you how volatile it is, and also the company is showing a weak dividend triangle right now. So it has a hard time to find revenue growth and earnings growth to maintain good margin, but that is on the opposite. They kept on increasing their dividend double digit. So it doesn't make much sense here. So just be very careful if you're interested into Enghouse at this point. It used to be a flourishing business, but after the COVID hype, not so much. Number 7 on my list, IA Financial, an insurance company with the latest dividend increase from 82 cents to 90 cents. So flush for a 10% increase. Still pretty interesting. So the company has a robust business model around insurance and selling asset management products. The company is also eyeing expansion in the US. So they made some acquisition already and they're growing their business there, as opposed to the big 3 life insurance companies that are eyeing the Asian market. IA Financial Corp focuses on North America. The last point on the bear case is the forward PE ratio is at 11, so showing probably a pretty interesting company at a decent valuation, which is rare these kind of days. On the bear case, well, unfortunately, it is a smaller player compared to Great West Life, Sun Life, and Manulife. That could hurt them when they go face-to-face in competition. As an insurance company, they are also exposed to interest rate fluctuations. So whenever interest rates are moving up and down, that will affect their bond portfolio to pay insurance claims. So you have to be aware of that. And finally, as they are looking to grow by acquisition, there is the acquisition risk for small players. Sometimes integration, paying too much, not having the right fit could hurt the company for a while. Number 8, a very under the radar company, but very strong, Thomson Reuters, TRI.TO. It provides professional information into what they call the big 3. So we are talking about legal professionals, corporation, tax and accounting. They do have Reuters News, but it's a very small segment of their business. Latest dividend increase of 10% from 54 cents to 59.5. So the bull case on this one, well, first, they sell subscription through their services. So it's all about recurring revenue, providing a super stable cash flow source. The second one is they operate in niche markets with sticky businesses. When you have like an accounting firm or a law firm that's subscribed to Thomson Reuters, they're likely not going to cancel their subscription because they need to get access to that information every single day. It's a critical part of their business. Finally, the company shows a robust dividend triangle where the revenue, the earnings, and the dividend keeps on increasing. Well, that's the benefit of having a recurring business model, right? On the bear case, well, one thing that I'm asking myself is how the company will be able to continue growth. So yes, they can continue low single digit by getting more clients, but once you get those clients, it's a little bit harder to expand and offer them new services. So while it's a sticky business model, not necessarily something that should grow double digit moving forward. The second point is AI and other disruptive technology could enter into their market and create a lot more competition. And finally, you have legal and regulatory challenges, especially Thomson Reuters is also eyeing the use of artificial intelligence in their business model, but that opens the door to potential lawsuits down the line. We are almost done with this marathon with only 2 companies left. Before we jump into those, I just want to invite you to download the Rockstar list. It's a list of stocks that we have pre-screened for you, showing only companies with a 5 years revenue, earnings, and dividend trend that are positive. So companies with a robust balance sheet that has probably a little bit more chances to fit inside your portfolio after you do your due diligence. So you can download it in the link description below, dividendstocksrock.com/rockstar. So number 2 on my list, Black Diamond Group, BDI.TO. Latest dividend increase from 3 cents to 3.5. So for 17% increase, it's providing modular and workforce housing solutions. This type of products is in very strong demand, especially in Western Canada up north. Most of their clients are related to the oil and gas industry, so that is a great way to make business. The company is also expanding to new client segments such as education and urban modular housing markets, which will provide a little bit more stability and diversification down the line. And finally, I really like the fact that they are moving into an asset-light model where they do rentals and services instead of selling the modules. So it enables them to get a constant source of cash flow, and it's a little bit more recurring than just selling module homes. On the bear case, well, while the latest years shows interesting growth, I've been burned by this one a while ago, about almost 10 years ago. Well, the market, especially in the oil and gas industry, was not that great. Well, they cut their dividend. I got burnt, so I still keep that in mind. Of course, as you can tell, it is a cyclical business. Most of their clients are either related to industrial segment or oil and gas. And finally, it is once again a small capitalization, opening the door to a lot of roller coaster. Finally, we're going to end this one with a pretty solid business. Yes, it is a small capitalization, but it has skyrocketed over the past few years. Terravest Industries, TVK.TO, latest dividend increase from 15 cents to 17.5 for 17% increase. It is a market leading manufacturer of home heating products, anything that is related to propane, natural gas liquid, transportation vehicle, storage vessels. So it's all about those storage tanks for energy. And the bull case, it is obviously a niche market in high demand, propelling the company to new highs. The company is also growing by acquisition, adding more than just organic growth to their business model. And finally, they have added a lot of maintenance services. So once they sell the tank, for example, they also sell the maintenance service, which will improve their margin and increase recurring revenue. Pretty smart move for their business model. On the bear case, well, another case of a small capitalization, so be careful with that. I would probably not pick the entire 10 of that list, especially because a lot of those are small caps. So just want to make sure that you're adding a certain level of risk. On the other side, in general, small caps tend to grow a lot faster. It is also related to cyclical industry, so mostly energy and industrial clients. Again, during economic slowdown, it's going to be a tough period. And finally, as they grow by acquisition, there is an integration risk. All right, guys, that's enough for today. As you can see, there was a lot of small capitalization companies in that list, but a lot of big names too, such as Imperial Oil, Thomson and Reuters, and Cameco. So I'm very curious about what is your favorite one among this 10. So I'll see you in the comment. In the meantime, do not forget to like and subscribe to the channel to not miss my next video next Thursday. And until then, don't forget to stay invested.